Afternoon, this is Lance Bryce with Thrive Mortgage. Today is Wednesday, the 21st of June. I hope you're doing well. Well, we are seeing interest rates pretty much completely unchanged, y'all, not just for the last week, but for the last month. Mortgage News Daily has the national average at 6.90% for a 30-year fixed rate conforming loan. Last Wednesday, we were at 6.97%. In that same survey 30 days ago, 6.95%. And keep in mind, we should have seen, and we're expecting to see, frankly, with good economic data on inflation, we were hoping to see some interest rate improvement that we just didn't get. We're going to go into some of the reasons why that didn't happen today on this call. First, the Federal Reserve Chairman Jerome Powell is testifying before Congress both today and tomorrow. He may receive some questions that give some indication as to where the Fed's headed that might give more guidance around what it looks like later this year. They have broadly communicated 2 additional hikes before the end of this year. That is baked into current bond prices. The bond market doesn't wait for those hikes to occur to price in that reality. It immediately trades on the future price that they're expecting because of Fed movement, but anything that he says that may change that would be impactful for the market in either direction. So it'll be interesting to see what he says. Secondly, remember that bonds are a globally traded commodity. When we see inflation here, it affects bond prices, but when we see inflation overseas, it likewise affects bond prices. The United Kingdom reported core inflation up 7.1%. This was much higher than expected. It's a 31-year high in inflation for the United Kingdom, and that is putting some pressure on bonds here because, again, they're globally traded. Part of what's moving Europe, y'all, higher and moving the UK higher is energy costs due to the Ukraine war. That's had a massive impact primarily on natural gas expense. That's being reflected in this number. But also their currency devaluation has also played into this. It makes their goods more attractive for us, but it makes it less attractive for them from an inflationary standpoint. So, and we're seeing that trade imbalance reflected in this inflation number as well. These are issues that are unique to the European Union. They're unique to the Ukraine war and how that is impacting the UK. That said, we don't expect this to be a contagion that infects us here. We should continue to see domestic inflation improving if we don't shoot ourselves in the foot further from an economic standpoint. I am concerned that we may have already done that with the debt deal that was struck 2 weeks ago. As a reminder, we have essentially enshrined $1.5 to $2 trillion deficits for each of the 4 future years. Y'all, we are now looking at $6 trillion $6 trillion budgets for each of the next 4 years based on the debt deal that was just negotiated. That doesn't take us back to pre-COVID levels of spending. We were previously in the $3.5 to $4 trillion spending a year mode. COVID hits, we jumped to $7 trillion last year of the Trump administration, and we've been at $6.5 trillion every year since, and it looks like we're going to be for the foreseeable future. The issue with that is, and as we said on our last call, we only take in $3.5 to $4 trillion a year in revenue. That deficit has to be made up in one of 3 ways. We're either going to grow our way out of it, and we do a lot, especially at the federal level, to get in the way of that economic growth. So it's asking a lot to expect the policies to be friendly to growing our way out of these deficits. Secondly, we can tax our way out of that deficit, which would be very detrimental to economic growth, or we can finance that debt by issuing a whole lot more in the way of bonds. That's what's likely to happen. That's what you're seeing reflected in current bond trading, is the likelihood that we're just going to be flooding the market with supply to finance that additional debt. Y'all, that's the circumstance we're in. I think it makes the prospects of us seeing rates in the 5s by the end of this year far less likely because, frankly, we've just enshrined deficits for the foreseeable future in a way that the market had not fully priced in prior to the debt deal. I do think that is the lion's share of what we're seeing as far as the stubbornness of interest rates not moving, even though inflation seems to be improving some. The market is frankly predicting that we're going to see that reverse at some point or stagnate, and that is a real concern. So in any event, I'm going to continue to keep an eye on it. I wish I had better news about where rates were headed. I would love to be on this call telling you that by the end of the year we'll be in the 5s as it looked 6 or 8 months ago that we might be. That's looking far less likely at this point. We need to adjust the folks that are out there on the fence about whether they should dive into the market. That current rates may be our new reality for the foreseeable future. They're still historically low, y'all. If you look at a 30-year average for interest rates, you still see them well above where we are right now. We need to convey that message to folks, let them dive in. If rates do improve, they can always refinance out of it. We make that very easy for them with our rate reset program that minimizes their closing cost on that future refi. So let's get them into houses. I'm here to advise them as best I can with 30 plus years experience to do it. You've got all my contact information. Hopefully we are earning your business. Feel free to reach out. Stay blessed, stay safe, and we will talk to you next week.